But we should go in and see some movement here, see how hawkish the Fed may be. Let me go in and take a look what we have as far as economic news today. We did have French consumer confidence this morning, also UK borrows. But as we come into today, we know that the big, let's see, come back here. Is going to be the FOMC decision, obviously, and we do have some a story or notation here in regards to that, and where the policy is going to stay accommodative. That seems to be the key word, as Dale mentioned yesterday. So let's go and move this out of the way. We're going to get into that. We're able to spend a little bit more time on the analysis. And as we know that with FOMC Day or any big event like NFP, you got to go in and widen those ranges out as to where the market potentially can go. So be just 1 second while I go and move. And we're going to cover what we have for today and get ready for the day ahead. We've seen the Canadian dollar just gently move higher. Actually, decent move over the last few days, but we've stayed fairly quiet over the last couple of days. Not a whole lot of movement, but as we said, the Canadian dollar steadies ahead of the Fed decision as NAFTA news loses clout. The Canadian dollar was little changed against its U.S. counterpart on Tuesday, shrugging off news on NAFTA trade talks as the performance of the greenback became the key driver of the currency. It's not really the marginal NAFTA news for now that's driving it, said Franco Burke, head of market analysis at Monex Canada and Monex Europe. It's more general trends in the G10 currencies and particularly the US dollar and how the G10 is performing against the dollar. Most other major currencies were a little changed against the greenback. Canada's not making any concessions needed to reach a deal with the United States for a trilateral NAFTA pact, and is running out of time before Washington proceeds with a Mexico-only agreement, a top U.S. official said. Well, that's just some pressure trying to apply on to Canada, but I don't think they're going to go along with that. And I'm talking about Canada. This, as Blake had pointed out also, there really is no reason. I don't see any reason for Canada going and do a deal at this time. We see the market impact of those types of statements begin to decay, Burke said. He expects a deal to renew the North American Free Trade Agreement will be reached over the next 6 months. As the monthly deadline for the North American Free Trade talks nears, Canadian executives who hedge foreign exchange risk have been changing their strategies so the companies can profit from any possible swing in the Canadian dollar. Let's go on and move on. UK retailers see only a slight slowdown after a strong summer with the CBI statistics. British retail sales growth slowed in September after a booming summer, but remained strong. A survey showed on Wednesday of signs that the Britain's consumers are not cutting back sharply on their spending as Brexit nears. The Confederation of British Industries monthly retail sales gauge fell back to positive 23 from positive 29 in August, a Reuters poll showed. Spending by consumers has helped to offset a broader slowing in Britain's economy since the 2016 vote. As we head into autumn, retailers have seen the run of decent sales figures continue, but underlying conditions are clearly tougher, with the sector facing significant changes from squeezed household incomes, changing consumer habits, to digital disruption. And the dollar flat before the Fed meeting. Investors eye the outlook. The dollar is flat on Wednesday before an expected Federal Reserve interest rate hike, priced in by investors, still on the edge about a trade row between the United States and China. The Fed is expected to raise interest rates for the 8th time since late 2015. Investors are also counting on another rate increase by the end of the year, but the outlook for 2019 is less clear. Focus will be on the central bank's policy outlook and comments on global trade dispute. We expect to signal that the future hikes are warranted, but more explicitly to acknowledge the downside risks associated with the trade and international financial conditions. The thought here acknowledging that downside risk would be worrisome for the dollar. I mean, worrisome in the sense that that would allow the dollar to pare back. And that says Hans Redeker. The meeting could temporarily lift the dollar, but a long-term boost was unlikely. So once again, what we've seen is the hawkishness by the Fed. And in this last meeting, I thought they would maybe make a mention of the concerns of potential slowdown, but they didn't. So if they stay rather hawkish, that will lift the dollar. That would be the thought process. But any mention of that would probably pull the dollar back. So we will find out. The dollar will take cues from the Fed's forward guidance and whether there are any noticeable changes in the dot plots, according to Fawad Razakad, the market analyst in London. Fed's officials' median projection on the number of rate increases is commonly referred to as the dot plot. This year began with the dollar retreating, but a hawkish rate outlook and the U.S.-China trade war have made it a safe haven for investors in recent weeks, though it's lost ground as other currencies such as the Eurozone improved and moved closer to a tightening monetary policy. The euro, on the other hand, rose despite a European Central Bank official downplaying Tuesday's comments by EC President Mario Draghi. Some analysts said the euro was also supported by the signs Italy's anti-establishment coalition is likely to reach a compromise over its 2019 budget. We'll get to that shortly. The euro was up 1/10 to 1771. Right now we're at 1745. Minoru Uchida, a bank's currency analyst, said the appetite for risk has increased the impact of U.S. tariffs on Chinese goods and remain relatively small. The Australian dollar tacked up 0.2 to 72.72. And moving on, in regards to those Italian bond yields, volatile before the budget deadline. If we do get a breakout and the euro moves higher, this may keep the euro in check from, let's say, going well above. Like, I think the euro has the potential to get to 18.50, even higher. But this, I would think, would have the potential to slow down any moves above 119. We've heard talk about 120. I don't necessarily see that, but this would work like a ball and chain if we try and get beyond 1850, I would think. Italian bond yields fell on Wednesday, reversing gains earlier in the session as a market looked for clues ahead of this week's budget deadline. Analysts said trading was volatile ahead of a speech by Economy Minister Giovanni Tria. Yields on Italian bonds were as much as 7 basis points lower after rising briefly after the open of the European markets. The market is reacting to whether Deputy Prime Minister Luigi Di Maio is expected to extract additional funding for his basic income program. It is likely to suggest the coalition is doomed. Di Maio said on Wednesday that a 2019 deficit exceeding 2% on output was not out of the question, though he added the ruling coalition will be responsible with the budget. The comments have come after overnight reports that Di Maio had threatened not to support the budget unless it accounted for key demands. Di Maio and Matteo Salvini, his ruling coalition partner, have pushed for a broad range of populist measures. So we'll see how this ends up going and playing out. But I would think until this is resolved, it would weigh as a drag on the euro. I still believe that the euro has a potential to break out, but any moves beyond 1850 or getting beyond much further, any move beyond 119, I think would be a tough call to handle if we still have this Italian budget situation at the forefront. And I think nothing's going to change there with this thing, I wouldn't think. Fed's likely to raise rates, possibly in accommodative policy error. With the Federal Reserve widely expected to raise interest rates on Wednesday, financial markets are focused on whether signs of an acceleration in U.S. economic growth will prompt the central bank to ramp up the pace of monetary policy tightening. This week's two-day policy meeting could mark the formal end of the accommodative level of rates the Fed has used. The Fed's current policy statement has included the description of loose policy as a staple element in recent years, though officials recently have described it as out of date and likely to be removed. The probability the Fed will raise its benchmark overnight lending rate by 1/4 percentage point on Wednesday, in which it could be a third hike this year, is nearly 95%. The larger question is whether the Fed reshapes its monetary policy outlook for the next few years to factor in stronger GDP growth, or whether concerns about a possible global trade war or economic slowdown show cause to stick close to its current view. Gross domestic product grew at 4.2% annualized in the second quarter, according to U.S. Commerce Department data released last month. Some analysts are expecting a more aggressive tilt when it comes to the policy statement due to be released at 2 p.m. Eastern Standard. The accompanying economic and interest rate projections from policymakers or Fed's Jerome Powell, the financial markets should prepare for a more hawkish tone, the Texas economist Joseph Livornia and Thomas Julian wrote ahead of the meeting. Another quarter of a 4% real GDP growth coupled with faster wage gains will likely cause policymakers to err on the side of aggressiveness at some point. So we got to see, like I said, the tone has been, or what we've been seeing is the Fed continues to stay hawkish. And I don't doubt that they're going to be hawkish. And I think that would suggest, obviously, the strength for the dollar. My question is whether it would be able to retain that strength. And my thoughts would be is, unless they're extremely hawkish or they remove that accommodative policy, I think the dollar is less likely to retain its gains. But we will see, and it'll be very key if they do go and remove the accommodative policy stance. Lastly, we'll just look at gold. People waiting for cues from the Fed. I think the Fed will stay the course, says John Sharma. The Fed may incite recent softness in housing and auto sales, as well as rather mixed beige book survey out last week that could conceivably justify moderation in the rate outlook. Any reference to that will weigh on the dollar. We think the dollar will weaken post-statement, so do I, and say this is the view of the fact that the Fed has been progressively selling off ahead of the Fed meeting, tells us that investors are likely discounting relatively dovish wording. Well, I don't know about the dovish wording. I'm just thinking that we mentioned that. I mentioned that earlier last week. We're past the point of diminishing returns, and we're just getting less bite. We talked about that, how all these trade war things, tariffs. Every time when we get an announcement, we'd see a huge rally in the dollar. The last time there was a trade announcement, when the prior Monday, when they were supposed to enact those tariffs, we got a 24-tick rally in the dollar index. So we're seeing less and less move, although I think the Fed will be hawkish. What's going to be key is the degree of hawkishness. And unless they remove the accommodative policy stance, barring something like that, I think to me, I would believe, I think that rallying the dollar would be, something you would fade. But we will see, because if they remove the accommodative that stance, then that certainly will flip things around and get the dollar back on the bullish bandwagon. People realizing that the trade war is likely going to continue. It's benefiting the dollar for now, but it could affect the U.S. economy as well as hurting the dollar and boosting gold, Sharma says. Let's go and move in now to the bias chart as we, hold on, let's click that off. Sure enough, that's exactly what I did. I just knocked out my Chrome, so hang on. This is actually where we ran out of gas. I think we ran out of gas yesterday. It was at 17.91, and we had a resistance at 94. Let's go and take a look here with the euro. Today's a big day. Where can we find support? Well, I had it marked off here, 1707. Let's go and engage a quick look at a fib. $17.07 actually comes in right at the 38%. But if we get a rather hawkish dollar, a little bit hawkish statement, potentially right there, 1691. Obviously, like I said, if the Fed removes the accommodative policy, we could really slide in that case. And I think you'd be looking at If the Fed removes that, then they're going to go on and take out the 1658. If they remove that, so if they remove that accommodative policy, I think we'd come down here as low as 1636. So keep that in mind. This is probably where they would come down if they remove the, the accommodative policy. I don't think that they're going to, in a lot of everything that's been happening with China. That really be, that's beyond pushing the pedal to the metal. That's pushing the pedal beyond even the floorboard. So I don't see that happening, but anything's possible. You got to go in and factor in those decisions. But I think that this is where they could potentially go to in that situation. I'm going to go on and mark this off here. $15.26. Call it 18.15. Now, barring that, where do I think they're going to go to? I'm looking down here for, you see right here, coming across all these touches in. That will be our area of what I'm looking to get to. 1691 as far as our support. As I said, if they were to move that accommodative stance, the dollar would really take off, and I'm thinking we'd make a run down here and probably take out the 1658. And we'll see. I think we would get some buying here. We'll have to see how the rest of the statement went. But for right now, just the general hawkishness, move potentially to 1691. Resistance this is what I'm looking at for. $18.62, which is 161%, and that would just be the overshoot of this 18.38. That's what I'm looking at for a potential target here. So let's move this here. There we go. So that's what I would be looking at as far as potential resistance here. We would end up, if we go into the dollar slides, we probably end up even pushing beyond that, but you have this key 1838 level, and so I think we push beyond that. Probably try and make a move towards this 1885, with 1862 being the 161%. So I think we could even get beyond that. But that's going to be the resistance. A little bit of an extreme move, which is going to be 1862. That would take out this 1838. But we would have a little bit of trouble here, this 1885-ish, just above that. But I'll give it, tell you what, we'll go with right there. 1867. So that's going to be our resistance. 1867 here for the euro. I think that the euro would probably have some tough time trying to get beyond 119 with this Italian budget stuff still hanging over the market. But let's go on and see where we stand here. Go and take a look here with cable, which is still holding up rather well. So when we're looking here with the FOMC, we spent some extra time with the euro. We'll probably spend extra time also with the cash dollar index. With the cable, good strong FOMC. Let's go on and once again, we'll throw up a fib. This would be a pretty good fall here, this 2980. Look, they already came down to 3056, and that was a key level here. We had even mentioned this in the chat room at the time when I was making that move down there. It would actually be, I think, right here, this 2981, which happens to be the 50%. This was the 38%. Generally, if you take out one fib, you don't stop at the next one. They usually end up going beyond that. But the cable would really have to fall apart. And that probably would happen if we saw the accommodative stance, but still we've been on a pretty good march all the way up. I think you would find willing buyers. So we'll say the 2981, which also comes in with some nice touches coming across here. So it would be 2981, a good fall, but that's if we were to push that far. That being said, provided the Fed is just the general hawkishness that we've seen, it's actually going to come in right there. All right. Coming in right there to overshoot that, it's going to be 3018. Still a pretty good fall, but it'll be 3018 on this slide. I think we could goose those stops. It might spook the market, but this will probably provide a pretty good buying opportunity. Once again, without the Fed actually truly removing an accommodative policy stance. On the upside, there's been a lot. I just saw where I think it was the Bundesbank was telling people banks to prepare. I think it was the Bundesbank. I'm looking about the Merkel and has no intention to have vote of confidence. But I am looking. They were saying prepare for no Brexit deal. That's probably not any big news. But the upside, I think, would still be rather limited. We're going to go right here with 3347. 3347 right here. This area, I'll show you. Got this little zone here. You see that? Very good level here, 3347. We're actually going to use that as our upside. I don't think the UK is out of the woods at this point after such a good, strong rally, but it's certainly still bullish. Let's go and move in now to the Aussie dollar. Well, if we do see the dollar going pair off, I think we will make it. We will make it to the 73.20, but we'll actually give it a little bit more room. It's going to be right there, just above here, which is going to be 73.50. That'll be our upside right here. We'll pull this back. Right here, you see that? Real good volume there. It's going to be 73.50 on the upside for the Aussie. If the dollar does pair back and we start, I don't think that necessarily would hit this in this session unless the dollar really comes apart, but we could start to see that in Asia or the day after. Support in the Aussie would come in just below this key area. 71.86 would come in right there. 71.70. 71.70. About a good 75 pips lower. And we'll move on to its cousin, the Kiwi. How far can the Kiwi push if we go and get this dollar to go and ease back a bit? We'll go in and take out this area. That'll be key area though, 67.21 here. But I think we can get beyond that before we finally start to see this market get a little bit tired. We overshoot this, kind of like in a sense the same way with the Aussie with the 73.20 area. Well, I think that would allow this market before it tired itself out. For a little pause, would allow it to get up as high as 67.81, 67.81. But once again, I wouldn't expect any move like that for today, but I would think that over the course of a 24, 36 hours, and the dollar really pairs back, that's eventually where I think we would go to as far as the target, 67.81 on the Kiwi. As far as support, well, this Kiwi's been so beat up, I think support will come in right there. It's going to be 65.81. We'll actually lower it just a bit. You can see the most touches coming across here, right there. So we'll go with 67.45 for support. We can also take a look here on the fib. $65.76 is a 61%. Let's go right. 65. I don't know why I was saying 40 something 30. It's right there. We can call it right there. 65.73. That's 65.73. And let's take a look where we stand here with the Canadian dollar. One of the things that was mentioned here on the story, and that certainly has some resonance, is that the market is getting a little bit weary of the NAFTA news. And at this point, I don't think that anything's going to be resolved. It doesn't make any sense for Canada or Trudeau to go on and, you know, I don't want to say cave in, but yield to what Trump wants. It just makes absolutely no sense. And I think they're smart enough to know that it's in the administration's best interest to pull out, to do the NAFTA thing ahead of the midterm elections. I just don't see where Trudeau's going to go on and say, oh, sure, I'm going to go and help you out after some of the things the administration has said. So it makes no sense. So I think that the market is starting to get a little bit weary and of the news and doesn't think that we're going to see anything really materialize in the next month or so. So I think this story will start to lose a little bit of its legs, just as the story suggested. That being said, where can we potentially go to? Well, if we do get a rally here, and maybe that's going to happen now, if nothing is going to embark or nothing's going to happen or materialize with this NAFTA news, then we can probably start to work a little bit higher. But that probably counters of what we're thinking is that the dollar will pare back. But as far as resistance, we do have the 38%, this 30.15. But if the dollar really gets some sea legs on it and we say, you know what, nothing's going to happen with NAFTA anytime soon, then I think you can see this level right here, 30.40. I think we can actually make it up to here at the 50% right there at 30.56. So that's going to be the resistance here at 30.56. And I think that is reasonable to reach. I think Blake's been pretty positive. Has been positive on the dollar CAD. But I think that the news is getting a little bit old. We had such a furious pullback and nary a bounce. I mean, we saw this one, but they're trying to hold their own, and there is some key support here. Remember, we had this 38% of this entire move here, and never quite made it. It's holding just above a couple of pips above that, but hold nonetheless it did. So is a bounce warranted? Certainly, I think so. Let's go on in. As far as support, I see this area right here, 28.17, right there. 28.17, I think would be good, very good support here. And with that, let's go and move on to the Swissy. Well, Swissy's had a nice rebound here. We've continued to go in advance after this market really got shellacked. Look at this. Let's go and take a quick fib on this one. And we know that the Swissy's been marching to its own drummer. So it does what it's going to do regardless of what the heck's going on with the dollar. So you can see here that 97.43 is going to be the 38% of this entire move, basically almost up to par 65, par 68, down here to 95.43. 97.04 is the bias pivot that we have in place. We could back this out, and you can see the importance of 97.04. You can see that. Look at that, going all the way back to August of last year. You see that? Resistance, support, and then a battlefield, support before we bounced up. And on the way back down, look where they bounced from, 97. And after that bounce from 97, you saw about a 150 pip rally. And then once we got past 97, then it was the submarine horns. It was just down, 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 down. And then once we got past 97, it was blue skies ahead. So we know the significance of 97. That being said, where could this market possibly go to? We know it's very oversold. Well, we could make it up here to this 97.43, the 38%, and it's 97.47, which is key. So if the dollar really makes a big move, I think that's where we can go to potentially on a little bit of a additional stops being hit. So we'll go with 97.47 on the dollar Swiss. If we get a rather hawkish Fed, I'm not discounting anything that the Fed's going to do, because I thought they would have maybe have made a mention about the this whole global trade mess the last meeting. And as I said, this last meeting they were, pedal to the metal. So I have no idea how they're going to go and play it. I mean, maybe this time they'll make a mention of it. Maybe, I don't know. They didn't the last time, but you would think as the tariffs continue to mount, you would almost think that it'd be kind of trying to think of the right word, but I cannot think of the right word, but it would almost be since just ignoring the obvious or not even acknowledging the risk. If after China has now thrown on its bid after the administration said it enacted some more tariffs last Monday, it's almost like as if you're disregarding that, like as if you're putting an ostrich, with the head in the sand. So I think that if they didn't even acknowledge the risk, probably get some heat from that. So they might, and if they do acknowledge that, I think it would actually work against the dollar. So they may stay rather hawkish, but still acknowledge the risk. So once again, I think my thinking is that it will be dollar bullish, but I think it's something that would be faded, but we'll see, especially if they remove the accommodative policy stance. We'll certainly get some extra juice here in the dollar. But once again, though, they've already been so hawkish and nothing's changed, and the dollar's starting to lose its shine on those rallies. But we'll see how this plays out. No one knows for sure. All we can do is play the ranges within the risk. So that being said, where is the risk on the downside if the dollar starts to slide? Well, we've already been beaten up pretty good here with the dollar, dollar Swiss. I'm just going with the straight up levels right here. You see here, resistance, battlefield, support. It's going to be 95.33. That's what I'm looking at, which would take those prior lows out. And after a huge fall, that would make good sense as a target they would go to and hold. Obviously, they remove the accommodative stance and really get this dollar moving along, but I like this area 95.33. Once again, you can see here resistance and a pretty good pullback on here of about a little over 120 pips or so. A rally back to 95.33. The market falls back. We get above it, fall back, and then eventually it's support 2 times before moving higher. So like 95.33 on the downside for support. And let's go and take a look at the dollar yen. I have not been a believer of this dollar yen, but you can't ignore the obvious. And I myself took a short trade on it and eventually got stopped out at 12.53. And I haven't tangled with it anymore. But I'll tell you what, the 30-year bonds have continued to move lower, although they're not that. Here's that key support. And I told you this goes all the way back to 2009. So although we're lower, what's one point when you're going all the way back to 2009? We see that. So if the Fed eases back, we could see a good strong bond rally, and that may pull the dollar yen lower. But once again, like I said, you got to give it its due. As long as it's above this bias pivot of 1166, things are still okay for the dollar yen. And boy, they're holding some shorts hostage at the moment. We had our resistance at 1284, and we've kept that. The market it's holding 10 pips above that. So we look back. Let's go and take a look here. My point has been it should have been a whole lot higher all along. Let's take a look at this daily. This daily's all messed up. I told you I updated all my charts, and then I did some system maintenance, and I lost all these. So this is just the 2-hour chart all transferred into a daily, so none of this has been updated. But what we're looking at for a daily, if the market would take off, you can see it coming right across. You see that 1369? That would be the target they'd go to, 1369. There's a little pause here at 1317, but we're not that far away from tripping it. So where would the market potentially go to? 1369 will be the resistance. If the Fed turned out to be, somewhat hawkish. As far as support, I'll be right here, 1195. You see these touches coming across. They would take out that 1211 because once again, with the FOMC, it stops the market fly through levels quickly. Although they can quickly retain those levels after they take them out. Well, the level we'd be looking at would be this 1211, but an overshoot certainly, and I think that would take us potentially down here to 1195 on the first look-see, and they pop back up and up to about 1240-ish, and then the market could rotate lower if that's the way it's going to go and play out. But it would be 1195 for our support. It's definitely bullish. There's no doubt about it. Can't deny that. I've had questions as to where the dollar yen should be. To me, I think the dollar yen should be closer to 114 in light of where the dollar's been, where hang on one moment. and in light of U.S. rates, but nonetheless, it's still moving higher. Now let's move on to one of the bigger topics of the day, which is going to be the cash dollar index. Where do we go with the cash dollar index? Well, let's go and take a look here in the daily. Certainly looks susceptible. We're looking at it on the daily chart. My take is, and this is where it came up, you heard me yesterday, I wouldn't be bullish on this thing unless it took out 95.52 on a daily. Well, now you see that's the reason why, right here. This 95.50 level is coming across, and I don't believe the dollar. It's got, like I said, everybody has their own take. I mean, things can change today depending on what the Fed says. If the Fed removes the accommodative policy stance, then we could see the the dollar, obviously take off. With the China trade stuff, whether they mention or not, moving higher, it probably would not behoove the Fed to go and remove that accommodative stance. I don't think, because if this whole tit for tat continues to move, escalate, then you could see the economy maybe, in the next quarter start to ease back, and maybe the first quarter we pull back even further, and then the Fed has to do a complete 180, so to speak. And so that, not that they'd be lowering rates, but it could really, then they probably question what the Fed's judgment and so forth. So it doesn't, I think the Fed's been in very good control. Obviously, the economic data has fortified their outlook, but nonetheless, I think in light of this continuing escalation of trade tariffs, it probably wouldn't be smart to go and remove that accommodative stance. Better to wait. I think they would have been removing it if there wasn't this trade war, but right now it doesn't make a whole lot of sense in light of all the other raises they've already done. So that being said, to me, it would take a close above 95.52 to take this back to bullish, and that's just looking at straight up technicals. So where's the resistance? I'm going to go with the 95.50 as resistance, 95.50. And I think we had it when we look on the 2-hour chart. It was at 95.52. We'll get to that. Right. We'll go right there. 95.56. 95.56. Now we talked about 95.32. Remember on the break of this, 95.32 would invalidate the bearish outlook. Now that was for then. Right now, we're talking about where could the dollar go to, and where would it find some resistance if we get a rather hawkish Fed? Well, to me, it's going to be based on the technicals right here, and we'll pull this back so you can clearly see. Right there. The rubber meets the road at, to me, technically speaking, at 95.58. That's where the rubber meets the road. 95. You can see the close here, which I like to go with closes. That actually coincides right here with the top right there. So look at that. 95.58. So it's 95.57 and a half, but I'll call it 95.58. To me, that's where the rubber's going to meet the road. And if you make a rally there, depending on what the circumstance would, I would be looking to fade. But like I said, we'll see how what all they say about the dollar, or whether they acknowledge the risk for trade war, whatever the case may be. And it would take a daily close above 95.50 in order for me to say, hey, you know what? The outlook's bullish now, back to bullish. So it's rubber meets the road at 95.58. Now, where's support? Well, we had our intermediate target. My whole thing was still we were going to make a move down to 92.80 with an intermediate target at 93.72. We almost got there, still couldn't quite make it, 93.72, but we saw that there was a huge daily support at 93.89, so the market's held. Where can we potentially go to and break to? And I'm just going here with touches, and let's take a look at something else here. It could go as low as here, 93.14, but that'd be 100 pips, and that's a long ways off. I want to give it some room, but that's a it'd be right here, 93.27, 93.27, coming right across here. Matter of fact, so I don't miss that. And just so we can still see it clearly, you can see these touches coming right across here. See that? It's going to be 93.27. I think we'd probably get a bounce from that area, or some, short covering coming in. That would allow them to take out these lows and push this market. We'll probably see a little bit of a bounce from 46, maybe get a rally up in here, 60 something, then the market comes back down to test it, and that's where they probably see some area here where the market want to target. And that's what we're looking at. Where would the market likely target? Because it's just a percentage game. None of us know. None of us has a crystal ball. No one knows for sure. We're just playing the percentages. Let's now go and move into gold. Gold's been treading water. And we're starting to slide back again here in gold here. And I think gold is more worried about where we stand here with rates. And actually, to be quite honest, gold has done a very good job. And I've left this trend line, I told y'all here, because it, to me, after broke here, it kept the market with a defensive tone. And you can see here, it just has not been able to regain that. And even though we saw that rally the other day, someone was asking about it, and I told them, look, unless we get above 1211, it doesn't it doesn't mean anything. And we did make it up to what, 1208.90, and we rolled back down and made up again. And we tried to make one more little blip up here, apparently during the Asian session, and here we are starting to slide back down again. So to me, it just reinforces that it's put itself in a defensive tone, and that's why I left this trend line right here. But that being said, gold's done a pretty good job of holding. It could be, a lot lower, not so much based on the dollar, although the dollar's been an impact. But look where U.S. rates are. So gold's done a pretty good job holding its own above water. I think if the Fed were to get turn rather hawkish, the first target they'd be going for would be 87.50. With the move coming down really to 1180. But we're going to go in and I'm going to go with this 1187. We'll call it 1187. There's support here. You can look at support here for 94. 94 is key, but where could it potentially get to? 1187. We're going to put the 90. I'll tell you what we're going to do, because we're looking at where the market initially would go to before we saw a bounce, and we're going to go right there at 1193. That actually happens to coincide with that low, but it's right here that I'm looking at. You see here, and then this low, and that happens to coincide with this 1193. I'm going to go with 1193 because if this, once again, 97 is key. You'd want to defend, which we did previously, defend this on a 2-hour close. We lose 1197 on a 2-hour close and really opens the door for us to move higher. But today's a big day. So if the Fed were to remain hawkish, we break through here. This is where they eventually would target 1187, and it could even get a lot worse because the way the market is technically set up. And it's already in a defensive tone to start with. But that's what they'd be looking for. That's going to be our support, 1193. But know that they need to defend that 1197 on a 2-hour close. So what would happen is if the market gets bearish 1193, we break down there, it's 1197 on any intraday rallies back that they'd be looking to fade. And it'd be important if they could reclaim that 1197 before the 2-hour close. But it'll be 1193 for our support. resistance. Well, if the Fed gets, if the Fed were to mention the risk of the whole trade tariff business, that's going to send the bonds running higher, which would open the door for the gold to move higher. Obviously, the dollar would then go on and slide. Resistance is going to be this 12.15. 12.15. We know that 12.19 is where it's going to flip everything, and then we start taking off like a banshee. But it's going to be, before we get there, we know 12.11 is going to be key, but it's going to be 12.15, 12.15, and maybe the market pairs back a little bit, then turns around, makes re-energizes itself, makes a shot, and it's 12.19 where you'd really start to see all kinds of stops being hit. If we able to go on and get very much beyond that, and the next real target then would be 12.27, but it's going to be 12.15 for our resistance. Obviously, this market is bearish. And let's go and move into the bonds. Once again, everything's all messed up here when these charts got messed up over the weekend. So apologies on this. I had already done charts that updated and everything was all nice and set, and lost all that. So that's why this thing looks like a bunch of lines all over the place. But this is a daily, and let me show you going back to 2000. You see, remember I had it even all the way back, but look here. You see that? This is back in October of 2009. So this is a pretty key area right here, this 40.25. Now we're below it, but like I said, when you're looking at something encompassing 9 years. What's 1 point? You see what I'm saying? So we're in an area that if the Fed were to kind of like acknowledge or ease back a bit, you can see a good 3-point rally in the bonds. So that would definitely take kick the stool out of the legs for the dollar. Obviously, send gold moving much higher. So and here we are. We're here at 40.04. We've been as low as, what is it, 39.17. I think we had the support yesterday, 39.21, but it already got. I think it had already gone down there. We'll take a look quickly. We had 39.17. We just put the day's lows. That's right. Remember, we just kept it the day's lows. Wow. If the Fed were to get hawkish even further, where would we potentially go? Well, they've already gone so far. Let's go and take a look at the daily, if we can find anything there. Right there would be. Oh, that's even good support there. That 39.24. They got a little bit beyond that. Oh, you see this high here? That little blip there, and that one comes in at 39.02. 39.02. So we'll go with that for support. 39.02. That might be hard for you to see, so apologies there. Resistance. Well, this market has been so beat up. That would be resistance right there. 41.01. 41. That'd be initial. But if the bonds really start to take off, it would be this 41.20. Actually be coming right there, 41.23. But we'll go with 41.01 for right now. 41.01. Same thing here with the Bund Daily. Lost all my charts there. So let's pull this back. Boy, that's a long ways off. Hang on. $57.66. $57.66. You can see this coming right across here. We'll go $57.66 on the Bunds. And be just 1 second. So I have to get my audio ready for now let's take a look at the resistance on here. It's going to be right there at 58.34. 58.34 on the Bunds. And we'll also take a look if we have a fib coming in there. Now, this is the most recent high, but once again, we're just trying to see if we can get some confluence there on a very short-term basis. That does come in right there. Just above there is at 38%. So I like that 58.34 on the upside for an initial target. So we had 12,326 as our support. Well, not bad. We missed it by 3 ticks. So that was our support, 326. It got down to, what was it, 323. This market is still susceptible. I'm just going to go with the technicals right here. 12,280 for support. I think we can actually go beyond that. So it's going to be right there. 12,262. Upside, we had 12,412. We got to 12,407. Not bad. We're off by 4 ticks or 4.5 ticks there. Resistance is going to come in right there. 12,377. 12,377 coming right across. That takes us here to the top of the hour, and Dale should be coming on right now.
Hi, Paulie. How are you, buddy? Good
I'm
morning.
doing good. How you doing?
I'm doing great, man. Do you live on the East Coast where you get to sleep in like normal hours, like human?
Not here in Texas.
Oh, okay. All right.
Although
So,
people that hear me talk think I'm from the East Coast.
yeah, I wonder why, because Paulie was kind of like a mafia name for.
Yeah, there you go.
Was that it, buddy? I noticed you're getting from a couple of people that are with you. They're interested in getting the format for the Excel sheet that you use with your presentation, your bias chart. I'm not sure. Isn't that only going to be available to members that follow you into this show next week? Do you know, or I'll probably have to ask the guys about it.
Yeah, this was actually Blake had always had this bias chart,
Right.
and then one of his listeners, I don't remember, Blake would know, had actually updated and made it super nice and clean with an Excel spreadsheet, which is this. And when I took over with the Morning Edge webinar, Blake shared this Excel sheet with me to go and use, and so that's what I've been using all along. But this is actually a variation of the one that Blake originally had, and one of his listeners was kind enough to put it together with all the little blanks to go and fill in. But yeah, you're right. I mean, sometimes I'll post this on Twitter, but for the most part, it'll just be available to the people that are in the webinar. And we go and lay this out now. My analysis generally focuses for the next 24 hours to the extreme. I would say extreme, but 72 hours. I mean, we'll put like the bias here. People might look at, maybe if they looked at the Eurodollar on the super long term and say, you're crazy, that's not bullish. On a short term, it's bullish. But the analysis, when we're looking at the analysis here, it's pretty much like yesterday we had 16 on the Euro had 1794 for the bias chart resistance, and the high was, I think it was 1791, and the day before I think it just barely missed or something like that. So it's a resistance for that day going into the next morning, just like the DAX.
Kind of perfectly suited for the kind of trading that you do, and a lot of people that just want to scalp during the day. And you're getting a lot of I've noticed over the last few weeks, a lot of your areas are pretty good inflection points for scalps. Let's just say, for example, you had one of your numbers. What's your average stop loss when you're trading one of these inflection points?
Generally, I look at about, I was talking to some of the guys in the room, the way these markets have been trading, I've actually had to widen my stops out and widen a little bit as far as my, like I'll use these numbers are going to come in. Okay. But one of the things I've noticed because of the volatility we've seen, and volatility in the sense that these markets, sometimes they don't go anywhere for a little bit, is what I'm finding now is I use these to enter, and depending on what the market volatility, like quite often I would use just like about a 12 pip stop. I mean, when I'm just scalping, maybe even less than that. But I found now that if I've expanded my stops a little bit, I can stay
higher hit rate
longer and get garner a little bit more. So one of the things that was, I'll give you an example. Yesterday,
letting them breathe, you're saying, has helped your success rate, hit rate on more winning trades instead of getting popped out.
We got up to that 1794. I may have only allowed like a 12 pip stop, and you can easily end up just getting, I don't say knocked out, or your profit target might be less. But I've noticed that if I give it a little bit, like Blake likes to say, a little bit more wiggle room, I can actually ride it out and try and, instead of just grabbing the scalp, grab more of a little bit of a day trade. And I think that that's helped me, because you have to adjust to the markets the way they are. I mean, when you get into markets that are going back and forth and flying back and forth, I think, to me, I trade more comfortably in those type of markets. But sometimes the markets aren't as accommodative, and you have to sit there and let the market dictate what's going to happen. And I found now that as I've expanded my stops, and allow for wiggle room, it allows me to
Right.
go in and just sit in the position and let it play itself out. So I've actually had to adjust to the way the markets have been trading. Generally, you see when we come back from summer, you get a week after Labor Day and everything starts kicking around and we're moving all over the place. And right now we're beholden
Not
to
this year. Yeah.
NAFTA trade headlines. So you sometimes you have to you have to get if you get a good level, you have to sit in that level because sometimes you'll find out you get paid much better if you sit in the trade. Although I still use my this bias chart from my Aries to step in and try and get the best price I can for the trade.
Great explanation. So let your trades breathe, everybody. Otherwise, you end up being right the market, wrong the trade.
That's happened to me. I'll tell you what,
Yeah.
that's happened to me. I'm like, I'm over there kicking myself and thinking, wow, I was here at that great buy level or that great sell level. I only got out like a few pips and it was a winner, but look, everybody else is riding it for 40 and 50 pips. And I'm over here thinking, oh man, this really isn't good stuff. So yeah, you make a good point. And I picked that up from Blake because last times people ask, where'd you come in? Blake goes, well, I came in here at this area, but I'm giving it some wiggle room. And I'll be doggone if Blake doesn't close out a trade for 50, 75 pips, maybe even more than that. And I'm over here with my few ticks winners and I'm, kind of kicking myself. Like you said, I might've been right the trade or right the idea, but ended up walking away with, nickels and dimes instead of,
you sound like me. We make the tough money and then let the windfalls
there you go.
get away from us sometimes.
And you have to adjust with the way the market's trading. If you're a scalper and then the market's trending, well, you're going to have to adjust, and that's what makes trading so tough. And sometimes, we all go through streaks where we're on top, we're doing really well, but you have to recognize the type of market that you're in, and when like I said, I think we're in a situation where you and I talked about, you have to give a little bit more wiggle room and let the trade work for you. And that's something that not used to doing, but you have to adjust to what the market will give you.
We're either growing or dying, Paulie. We always have to adjust. And, sometimes people ask me, Paulie, oh, your handle's Forex Stop Hunter. They go, well, Dale, how do you know where the stops are? So I say, well, why don't you just imagine you're short this market right here? Where would you put your buy stop? And then, they'll go to the next swing high and say right over here. And I said, well, that's where everyone else's is. Don't do that. Okay. So, everyone is, it's easy to figure out where the stops are because all you have to do is imagine yourself, you're long or short something, and where would the obvious place be? And that's where everyone else's are. So I kind of tell people, give those areas, those swing highs and lows, maybe an extra 20 pips or so, not 1 pip above it, because the algos are going for liquidity up there. So, anyway, cool, Paulie. Any inkling on the Fed? Will they remove that word accommodative today in the statement? What do you think?
I don't know, and I think that's the best thing I can say is I just don't know because none of us know. I was telling people, none of us know. We just all we're doing is playing percentages. I would have thought that the Fed would have been acknowledging the risk the last time. The only thing that makes me think, and the people thinking, you mentioned yesterday about removing that word, the accommodative stance, is that China reacted and added its own tariffs after the administration added additional tariffs last Monday. And I think the people probably considered irresponsible if the Fed didn't acknowledge the risk. And I'm thinking, I don't think they would remove the accommodative because you really box yourself in the corner. Because if this whole trade war just keeps on rolling and then we start to see a slowdown, not a big pullback, but start to see a slowdown in the fourth quarter that rolls into the first quarter, then the Fed has turned around and boxed themselves in. And I have to give the Fed credit. They've been doing pretty good job really over the last few years. I don't see why they would box themselves in. So I'm thinking they wouldn't remove the accommodative stance, but we'll see. Who knows?
Okay.
We'll find out at 2 p.m. Eastern.
Yeah. Okay, Paulie, thanks so much. Kumar, I see you in the house. Your interview begins in exactly 15